The meeting is being recorded, and I am the IEO lead evaluator at the IMF. We have three very distinguished guests today with us, and the slides that some of them will present will be posted alongside the recording on our website. So make sure you download those and keep them safe, because there's a lot of good information there, which is going to be very important for not just IMF staff, but everybody who's interested in this matter. Let me just go through the guts of what we're going to talk about and give you a 30-second introduction to our speakers, who actually, none of them, I think, need introduction. So we know that there are plans to, change the way money works. But these plans come on top of a process of financial innovation that has begun a while ago already. So new financial networks that will be created through these innovations, or have already been created, have been shown to be able to increase participation in the economy, what we normally call financial inclusion. And perhaps even stop the concentration of wealth in some form through that financial inclusion, but only if they're used with care. So in this webinar, Giancarlo, who's former commissioner and chairman of the United States Commodity Futures Trading Commission, and a blockchain technology advocate who has made key contributions to the global discourse on cryptocurrencies and digital assets, discusses his recent book on this subject, CryptoDad, The Fight for the Future of Money by Wiley. And you should know that CryptoDad is Giancarlo, so that's the nickname he comes with. Tommaso Mancini-Griffoli, who is here with us as well, IMF division chief in MCM for the division Payments, Currencies and Infrastructure, and Natalie Smolenski, who works at Hyland Innovation and Texas Bitcoin Foundation, will offer insights on the cost-benefit trade-off of digital monies, looking at their potential impact on banks and other financial institutions, looking also at the role of sovereign regulatory responses, and perhaps of the role of the IMF in this revolution that is taking place. Let me say just in a few seconds who our speakers are. Just let me go through a little bit more in detail so that you can appreciate the luck we have to have them here today with us. So Giancarlo is an American attorney and former business executive who served as the 13th chairman of the United States Commodity Futures Trading Commission, CFTC. He was a commissioner before under, I understand, the President Obama appointment, and then under President Trump, he actually became chairman of the commission. He is a blockchain technology advocate and contributor to, as we said, the debate on currencies called cryptocurrencies and digital assets. He founded the Digital Dollar Project to advance exploration of a United States central bank digital currency, and he's former director of financial service company BlockFi. Tommaso Mancini-Griffoli is division chief, as we said, in MCM at the IMF, and his work focuses on monetary policy, central banking, as well as digital money and fintech. Prior to joining the fund, he worked at the Swiss National Bank, Goldman Sachs, the Boston Consulting, and software startups in the Silicon Valley. And Natalie Smolenski, last but not least, is an anthropologist and business development executive. She founded and leads the Texas Bitcoin Foundation, a public charity dedicated to original research and education about Bitcoin and political economy. She's also senior fellow for the Bitcoin Policy Institute, where she writes and speaks extensively about the dangers of central bank digital currencies. She has an SAS startup. She's a SAS startup founder and currently leads business development at Hyland, a U.S. leading content service provider. And she writes and speaks about identity, technology, and government. So without further ado, I would just pass the baton to Chris, who has a wonderful presentation, is going to share his slides. And in there, I think there's everything you need to know about what's going on, both private crypto and public crypto, as well as some very interesting insights of what's going on with this FTX scandal. So buckle up, Chris, the mic is yours.
Thank you, Nicoletta. And can you see my screen? Has it come up on for viewing?
Yes.
Okay, good. So thank you, Nicolette, and thank you everyone for this opportunity to be with you today. I'm so pleased you referenced FTX as a starting point. I think it's something of an 800-pound gorilla in the room, and I think we cannot ignore it in any presentation. I don't intend to ignore it today. I'm actually speaking next week in Miami at the Managed Funds Association conference, and I got a call yesterday morning from the organizer. And the organizer said, look, we'd like to change the title of your remarks. I said, okay. I think the remarks are entitled something like the future of crypto and central bank digital currency, rather bland title. And so I said, what do you want to change it to? And he said, we're going to change it to crypto. What the hell happened? I said, you know what? That's probably the perfect title, because I think a lot of people are wondering that themselves. You know, when I speak to audiences about crypto, sometimes in a live audience, I'll often ask for a show of hands. When people think of crypto, how do they think of it? And sort of the 5 most common responses I get, why is this not popping up here? Oh, there it is a first one is a new highly speculative tradable asset class, a faster and more efficient means of payment. Digital gold, in the case of Bitcoin, some people think of that because of its program scarcity. A scammed and a fraud naive investors is certainly one that always comes up, and perhaps in the case of FTX is one that will come up frequently still. And then lastly, all of the above. Those are probably some of the most common, and if you read, and spend any time reading the papers in the last few months and the fall of FTX, probably all of these categories are front of mind for most of the public. But what I want to ask you to do is actually think about it in a different way. Those are certainly all true, but the way I think about crypto, and the way I have been thinking about it for almost a decade now, is a series of algorithmic protocols that operate on digital networks to record and confirm the holding and transfer of things of value, including money itself. And as I want to show you today, that's a pretty powerful, if not an awesomely powerful concept. In fact, a recent research report from Bank of America that came out this week said that digital assets could be the most important transformation of financial services in the history of financial services. I don't know if that's true, but I do want to make the point to you that crypto is a lot more than just some speculative new investment asset class. It really is a new architecture of finance, a new architecture of where value is, who holds value, who transfers value to whom. And by value, I'm talking about everything from automobile titles to votes in election to ultimately money itself. So I'm going to give you just a quick background on myself, because it's important to know how I got here and how I view this. So I spent my first 16 years as a practicing lawyer in New York and London. And in the year 2000, I teamed up with a group of entrepreneurs to take a firm called GFI Group that was a small, what they call interdealer broker, to actually build one of the largest global networks for trading over-the-counter swaps. And we took that company public in 2005. And by 2008, we had become the world's largest trading platform for a type of over-the-counter swap called a credit default swap. Now, we were not a trading house. We didn't trade swaps. We were merely the platform on which they traded. I've often explained to people, we were the exchange for instruments that didn't trade on the exchange. And as I said, we probably had about 80% market share in the trading of credit default swaps. So we were truly at the eye of the storm in 2008 during the financial crisis, when the the prospect of credit default swaps not failing, the prospect of credit default swaps working, and therefore the major money center banks of the world calling in their swap protection against the failure of each other could cause a global financial crisis, led many questions. And I remember a few days before the fall of Lehman Brothers in September 2008, getting a call from a senior official at the New York Federal Reserve. And the conversation went along the following lines. That is, hi, I'm so-and-so. Do you remember we met at a cocktail reception at the New York Fed a few months ago? Can you remind me what you guys do again? And I said, well, of course, we're with the exchange where credit default swaps trade over the counter. And he said, right. And he said, so what are you seeing in the market? And I said, well, today, for example, credit protection at Lehman Brothers began at 500 basis points over Treasury. Now it's closer to 600. Basically, they're a dead man walking. And he said, that's interesting. And what are you seeing in other names like Morgan Stanley and JP Morgan? And I went through how the spreads were gapping out. And he said, that's absolutely fascinating. So what you're saying is that you're kind of seeing a barometer on the health of these major institutions. And I said, yes. And he said, I'd like you to swing by the bank and explain this to some of my colleagues. And I said, I'd be happy to. I said, I just don't know when I'll get off the trading floor. It's absolute pandemonium here, maybe by 9, 10 o'clock tonight. And he said, oh, no, I can't do that. I've got a kid's soccer game tonight. Tomorrow's pretty busy. Why don't we look in the diary and look at a date maybe in the middle of October? Well, as we all know, it was all over by then. Lehman Brothers fell a few days later. They were effectively dead 48 hours before they fell. What struck me, and this is the point of the story, was that regulators had no better way of knowing the credit health of some of the most important financial institutions than calling around to an intermediary like mine and asking where were credit spreads and can you even get credit protection against certain names. And over the next few years, the incident reverberated in my mind. And so when I started reading about blockchain technology early in the next decade, I thought, oh my goodness, if all of the credit default exposure of banks had been recorded not on fax papers circulated around Wall Street and around the globe, but had actually been on a blockchain, then policymakers would have known in real time the exposure of firms. In 2008, it was believed that the gross notional outstanding amount of exposure against Lehman Brothers, were it to fail, was $400 billion. And basically, they extrapolated that and said, well, if exposure to Lehman Brothers is 400 billion, then exposure to, say, Morgan Stanley must be 800 billion, and exposure to JP Morgan must be 1.2 trillion. Therefore, let's come up with a TARP program that floods these banks' balance sheets with liquidity in case they fail. But we now know, in part by work done by the chief economist of the CFTC, that the net exposure, not the gross exposure, but when you net down all of those swaps protection written against Lehman Brothers, was not 400 billion, it was less than 9 billion. And in 2008, we knew the exposure was less than 9 billion because all those swaps were on one blockchain. Then our policy responses to the financial crisis could have been very different than the TARP program. For one thing, we could have let Lehman Brothers go bust. We knew we would have known it wouldn't have brought down the world financial, it wouldn't cause the world financial crisis. Or Treasury could have written a check and bailed them out. But those options were not available to us simply because in the fog of war, we didn't have the data. And we didn't have the data because technologically, it was a series of separate bank balance sheets. There was no distributed ledger. And so I started following this. And when I got a call from the Obama administration in 2013, asking me to serve at the CFTC, this was something that was very much on my mind. I took my seat in 2014, and I went there to complete the reforms to the swaps market that were in the United States Dodd-Frank bill and a lot of global legislation. But while I was there, I continued to focus on this notion of blockchain. And as I recount in my book, CryptoDad, The Fight for the Future of Money, by 2015, I've really been studying Bitcoin. And the first thing I did upon becoming chairman in January of 2017 has created something called Lab CFTC, and I charged it to understand cryptocurrency and the underlying blockchain technology. I can't figure out why this is not moving forward here.
You have like a little, you select something different from the.
This is the strangest thing. It worked when we did it before.
Okay, it did. What about the arrows? Oh,
I'm sorry, everybody. I can't figure out. Let's see what we got here. Does that do anything? No.
Maybe stop sharing and share again.
I might have to do that. So I apologize. I'm going to.
as you do that, there was a question in the chat saying this is not a blockchain lack of technology, is more of an issue with imperfect disclosure to the regulator.
Well, not really, because it was impossible to know net figures without a blockchain. There was no way for one institution to confirm how many times that credit exposure that was sold on that institution was re-hedged in other places. The blockchain would provide that netting down of positions. That's why the federal regulators were only looking at gross positions. But I'm just going to carry on, but I do want to come back to that later. During the course of the first few years I was at the CFTC, the value of Bitcoin grew tremendously. And in 2017, we were approached by two large of our exchanges, Chicago Mercantile Exchange, Chicago Board Option Exchange, about licensing Bitcoin futures. And there was a lot of pressure on us at the CFTC, and me in particular, to block the launch of Bitcoin futures. And yet, a couple of things. One is I felt, in fact, the presence of a futures market would actually moderate some of the bubble that was growing in Bitcoin prices. But more importantly, philosophically, I felt it's not for regulators, at least in the American system, to approve or disapprove what investors can invest in. It was for us to make sure that if investors wish to invest in an asset class, to put a regulatory regime around it that provided transparency, orderliness, freedom from fraud and manipulation. And so that's what we did at the CFTC. We repurposed our rule set to allow for the emergence of a Bitcoin futures market. And 5 years later, here we are in 2023. The only thing that hasn't failed virtually in crypto, not the only thing, but one of the things that hasn't, is that 5-year now operating Bitcoin futures market that we began at the CFTC in 2017. In fact, it was the first truly fully regulated market for any form of crypto. And 5 years later, that market is liquid, it's transparent, and it's operating quite well. Nevertheless, right after licensing and greenlighting the launch of Bitcoin futures, I was called before the Senate Banking Committee. And in February 2018, I was questioned by the committee considerably on that decision. And I made the case that in a free market, it's vitally important that regulators not see their mission to pick and choose what products are available, but to make sure they operate in a well-regulated, well-functioning system. And that's what we did. And it was in the course of that hearing, which I recount in my book, that I was awarded the nickname CryptoDad. Now, why do I say that crypto is a new architecture? Well, let me just take you on a brief historical journey. I'm going to do it twice in these remarks. The first one, I want to talk about historical journey through the 20th century. One of the most important inventions of the 20th century was the semiconductor. The semiconductor allowed us to take large, giant mainframe computers out of college campuses and military institutions and reduce them to personal computers and populate the globe with tens of billions of them. But as important as that hardware development is, I would argue that it was actually the software development of key protocols like TCP/IP and HTTP that allowed those computers to talk to each other that was a far more fundamental transformation. It transformed all manner of information and, quite frankly, social activity, from the way we listen to music, to the way we see video, to the way we conduct retail shopping, the way we conduct local transportation, travel and leisure, video and photography, communications. Just take communications, for example. Historically, when I was a young man and would travel abroad and would want to speak to my parents, I'd call home on a Sunday, and my mother would always begin the conversation with saying, "You've got 5 minutes because this is costing us an arm and a leg." Now, not only students traveling abroad, but whole populations of immigrants around the world are able to speak to their loved ones 24/7, 365 at virtually no cost. And why is that? Because they've moved those communications off the proprietary rails owned by Bell Telephone and Ma Bell and Alcatel and British Tel, and they've moved them onto the internet. A telecommunications breakthrough based upon internet-based communications to have enormous social implications. And of course, social networking with Facebook and LinkedIn, and business meetings like the one we're doing right now with Zoom and Teams. That's called the first wave of the internet and Internet of Information. We've also seen a second wave of the internet called the Internet of Things. Devices talking to devices, devices getting every smaller because of Moore's law, allowing for every smaller processing capability. But once again, it's the key protocols like Wi-Fi and Bluetooth that have allowed these devices to bring that social change brought about by that second wave. Well, many argue we're now in a third wave of the internet. This time, it's not an internet of things or value, but an of communications, but an internet of value. The same concept. Can we move value out of proprietary systems and use it to communicate on the internet? Well, the breakthrough in this internet of value was that famous paper written by he, she, or they, Satoshi Nakamoto, that proposed with the right protocol, we could actually move value onto the internet rather than on proprietary balance sheets. And those key protocols today, no different than HTML, are BTC, Bitcoin, ETF for Ethereum, Solana, USDC. When I think about crypto, I think about it in terms of key protocols that allow for value to be established on internets. So again, what is crypto? It is using distributed ledger technology and cryptography to record ownership and transfer of value on the internet rather than as assets and liabilities on proprietary balance sheets of the world's roughly 7,000 commercial financial institutions. And this notion that you can establish where value is and who's transferring value to whom on the internet, rather than as we've done for the last 400 years on the balance sheets of proprietary institutions, is launched already in its first decade. All kinds of products and technologies, from cryptocurrencies to stable coins to what they call DAOs, computing protocols, decentralized finance, non-fungible tokens. And we're only in the early stages of this. Where this will lead is like knowing back in 1990 that somehow this notion of computers talking to each other would lead to Uber or FaceTime. We didn't know it then, and we don't know exactly where, but I can tell you we're only in the early stages, and it could be remarkable. So what has been the public sector response to what's effectively been a private sector innovation? Well, it started with cautious indifference. Let's see if I get rid of this here. Sorry about that. A combination of cautious indifference to regulatory accommodation. If you look at what central banks have done in the area of central bank digital currency, which I'll turn to in a minute, and some market regulators like ourselves at the CFTC and others, and now we're leading to national legislation. But we still are also seeing a fair amount of what I call regulatory hostility. Here in the United States, a legislative process is underway, and I'm optimistic that in this current session of Congress, this 2-year session, we will see some combination of both targeted and comprehensive legislation. I don't want to go into it because I do want to turn back to the FTX fiasco. The problem with FTX, well, there's many problems, but one of the key problems is it combined two things or three things that should never be done together. And that is proprietary trading with trade execution with brokerage activities. With, in my background, having run a trading platform on Wall Street, one never engages in trading if you're running a platform. You either do execution or you trade. You can be a hedge fund or you can be a trading platform, but you can't be both. It operated in an absence of financial regulation in many jurisdictions abroad, an absence of transparency, rampant conflicts of interest. And if I were to use a series of historic analogies, I would say it's a combination of Madoff, Nick Leeson, and Enron. Madoff in that he used this fear of missing out, the shiny new object of crypto to drive people in, with Nick Leeson's having traded himself into a bad position and believing with more leverage he could trade out, only to make the whole worse. And Enron, that temptation to drop into client accounts. I might even say MF Global. But at the heart, this was an old-fashioned crime, appropriating the promise of a transparent, decentralized internet with an opaque, conflicted, and centralized platform. And yet, FTX will have continuing political and social effects. Another analogy I would give is 19th century railroad development. One needs to distinguish the fraudulent sales of early railroad shares, which was rampant, with the railroad as a technology and how it fundamentally transformed the United States economy by taking a series of regional economies and wielding them together into a national economy that was then able to emerge as the world's largest economy. You have to separate the wildcat sales of those railroad shares from the fundamental underlying technology and the change it brought. So this current crypto winter, why are we there? Well, I think this promise and the valuation of internet-based value transfer got ahead of the end of QE and the beginning of a new quantitative tightening global credit cycle. Basically, there was too much money floating around and ventures like this were too easily done. We also got ahead of the state of development of the underlying infrastructure. And I would include in that infrastructure legacy financial systems and legacy regulatory networks. I would also include, and this is something I mentioned in my congressional testimony, we really do have probably the biggest generation gap since the 1960s. And I grew up in a period of time when there was something called the generation gap, where young people and their older generation just fundamentally disagreed on things like civil rights, and here in the United States, the Vietnam War. Well, I think we're in as big of a generation gap today, but it's about technology. There's a generational status quo bias to the financial system as it exists today. In the minds of many older generation people, branch banking is fine. 3-day settlement is fine. Paper checks are fine. But for young people, they just don't get that at all. They are in a different place. And that young people do not understand why it costs so much money to move money around the globe. They don't understand 3-day settlement cycles. They don't understand why value has to be stored in a bank institution as opposed to something more accessible in terms of the internet. And finally, I think we had kids and crooks playing with too much money without proper adult supervision. Another analogy I would give to where we are now is the 2000 dot-com bust. The failure of pets.com in 2000 was not because consumers did not want to purchase pet supplies online. It was because they didn't want to do so using dial-up modems and waiting 2 to 3 weeks for delivery and investing in those companies at high valuations. When pets.com crashed, there was about 361 million users of e-commerce around the globe. And notwithstanding its crash, and remember, there were headlines then saying e-commerce is over, .com bust, it's not coming back. And yet by 2010, there were close to 2 billion users of e-commerce. And today, e-commerce is ubiquitous with over 5 billion users around the globe. So what's happening today? Well, we're seeing a flight to quality. A shift is underway from crypto speculation to real world usage in trading, payments, and investment. And we've read the headlines about BNY Mellon and NASDAQ and Fidelity and BlackRock and State Street all moving into this area. And you can search right up to yesterday, and none of them have said, as a result of FTX, we're backing out, we're not going to go forward with our major investments. Okay, so with all of this going on, it's led to enormous interest in digital assets and crypto by finance ministries and central bankers as a means of payment, as a store of value, as a unit of account, and an opportunity for more effective regulation. The public sector's response is largely focused on central bank digital currency. And what is that? Well, it's digital currency issued by a central bank, backed by the full faith and credit of a sovereign government that trades at par to paper money. And if you look around the globe today, and the Atlantic Council does a periodic updating, keeping statistics, over 100 of the world's central banks are now engaged in research or experimentation toward developing CBDC. 50 of them are in advanced stages of exploration, including 19 of the G20. Europe has said they will launch a digital euro by 2025. The Biden administration has said that work on a US central bank digital currency is urgent. And as many know, China has already placed their ECNY, their digital yuan, in over 250 million digital wallets. So I just want to distinguish central bank digital currency and explain to you why, in fact, it's not as odd as it sounds. So if we think about history of money, from the dawn of civilization to roughly 400 years ago, the only form of money was basically tokenized money, whether it was a metal coin or a cow or a shell or a bead or the dollars or pound notes we use today. With tokens require only the verification of the token itself, not of personal identity. And as a result, tokens are fast, cheap, and very inclusive. The one shortcoming, however, of tokens is that they are localized. That cow, it's hard to take that to the next village or the next country. That dollar bill will work in New York, but it won't work in Paris. So society came up with a different system. Not very long ago, about 400 years ago, the Bank of Amsterdam said, you know what, if you're leaving Amsterdam to trade in Venice, put your guilders in the basement of our bank and we'll give you a banknote. And you can take that down to Venice and get credit from a local bank down there, because they're going to trust our credit, the Bank of Amsterdam, not necessarily yours. And so they issued banknotes, and it allowed for safer and more convenient movement of value around the globe. Today, 90% of the money in circulation are banknotes, and it financed the age of discovery. Now, bank money exists as assets and liabilities in roughly 7,000 banks around the world, but they have a different system. They don't require verification of the thing itself. They require verification of the account holders. Basically, for every transaction, the identity of the counterparty needs to be established in order to establish where they bank and that there's enough money in their bank to settle the transaction. The shortcoming of bank money is that it's slow because people need to do all that verification. It's expensive because they need to be paid to do that verification. And it's exclusive. And perhaps that's the worst shortcoming of all. To be a part of financial inclusion today, one needs to have sufficient credentialed identity to be part of it. And yet in a world of 8+ billion people, 1.5 billion for a variety of reasons, don't have sufficient credentialed identity or don't wish to obtain it to be able to include it in this system. So what new technology is available to make value less local and more global than under the token money system, to make access to and transfer of value faster, cheaper, and more inclusive than the current bank money system, and to enable value, maybe for the first time in human history, to move efficiently across both space and maybe even time with programmability? Well, it's central bank digital currency. And in my book, I write about what I think are the 7 factors driving central bank interest in central bank digital currency. And I don't want to go through them now and take too much time other than to say it's data capture, it's infrastructure upgrade, it's financial inclusion, precision monetary and social policy, it's the rise and the competition of stablecoins, it's geopolitical influence, and then it's something I call karma. Money has always carried with it values. And I spent a year with the Hoover Institute on a study of China's ECNY. And from it, I've concluded that because of the surveillance features that would be built into the EC or are built into the ECNY, there will be many jurisdictions around the world that will want that technology. And they'll either use it directly as part of China's Belt and Road Initiative, or they'll use it as a white label version for their own currency in order to have that surveillance capability. And I think designing a US central bank digital currency or any digital currency of the world's democracies presents an opportunity to move away from surveillance, move away from censorship of the use of money to something I call freedom coin. And I have a paper coming out next week in the American Enterprise Institute that it's going to dive into this issue of surveillance coin versus freedom coin more directly. So what about a digital dollar? Well, in January 2020, I founded something called the Digital Dollar Project, calling on the Federal Reserve to advance its exploration of a US digital dollar. And in March of last year, the Biden executive order called research and development of a digital dollar of the highest urgency. And last summer, Chairman Powell said that a digital dollar could help maintain the dollar's international standing. We at the Digital Dollar Project have moved from advocating US taking a leadership role in the development of central bank digital currency to actually working with participants in various industries to explore how a central bank digital currency impacts or benefits different markets. And recently, we announced the very first in human history pilot to test the US central bank digital currency, and the first pilot in history of any central bank digital currency of any denomination that was entirely private sector led, not initiated by a central bank. And this pilot was with the Depository Trust Clearing Corporation to see how a CBDC would assist in what they call atomic settlement and clearing of securities. That is, transaction by transaction rather than batch transactions at the end of a day or 2 days or 3 days. And that's just one of 9 pilots that we'll be doing, looking at a range of CBDC uses across from wholesale use all the way to retail use. Earlier this week, the Digital Dollar Project released an updated version of our white paper called Exploring a US CBDC, with a series of recommendations for US leadership in global CBDC development. So in conclusion, what's to come? Well, I believe it's naive to think that the internet will not do to finance and money what it has already done to other human activities: increase efficiency, lower cost, increase inclusion, and overturn traditional market structures. To think that somehow finance and banking and money are immune from what the internet has done to every other social activity, I think is naive. And as a pre-internet generation of policymakers gives way to a generation that grew up in a networked world that understand digital networks intuitively, this internet of value will be second nature to them. And this internet of value has already started and will continue despite the FTX scandal and its reverberations. And how to prepare for this? Well, I think we need to anticipate the direction of innovations toward an internet-based architecture of value. We all need to understand crypto as software. Now, it also may serve a capital formation function as a security or a commodity or currencies. Software can do many things. And to the extent it serves as a security, it's subject to securities regulation. To the extent it serves as a commodity, it should become subject to proper commodities regulation, as we did at the CFTC. And in all its other forms, it should be subject to appropriate regulation. But to do that, those regulatory frameworks in many cases were written a long time ago in an analog and physical world. The regulatory frameworks here in the United States go back to the 1930s. And the only way, until our Congress and other legislatures come up with bespoke legislation, we need to repurpose those regulatory frameworks to function with this new digital architecture. And I think we all need to help our policymakers understand this innovation, develop well-suited legal and regulatory frameworks for the future of digital money. And finally, I'd say, let's not be afraid of this. I can't believe how much fear and loathing I'm reading in the paper about FTX. And yet, you know, it's the same old, same old. That doesn't make it okay. Not at all. But it's not the reason to somehow pause development. And one final thing. You go to any country in the world, and many of the developing countries where the average age is under 30, they are adopting this as fast as can be. They fully get this. The problem is our well-developed societies that have long had well-functioning analog-based financial systems that seem to be fearful about the direction of travel. I think we need to offset that fear with an openness to this. Now, we need to bring all that we've learned to bear. We need sound and solid and well-functioning regulatory frameworks. Nothing has changed the human tendency to mistakes, in some case, fraud and failure. We need adult supervision, but what we don't need is fear. We need openness. With that, I'm delighted to let my colleagues speak and take some questions if we can. Thank you very much.
Thanks, Chris. This was extremely clear and insightful, and I learned a lot. I have a few questions myself, but I think the best thing to do is to pass the mic to Tommaso, who has prepared a short discussion. You got 10 minutes, Tommaso. Go ahead.
Thank you very much. It's a great pleasure to be here. And Chris, I thoroughly enjoyed your presentation, as I did your book, which I have here, CryptoDad. I guess if you're the CryptoDad, all of us working on this topic must be your children somehow. So this all remains in the family. Chris has this unique perspective. Chris is somebody who gets excited just as much by being on a rooftop bar with his kids talking to entrepreneurs, the story is written in the book, as he does by being in the office of Jay Powell or in the BIS building in Basel talking about regulation. So this unique perspective of both an entrepreneur and a regulator makes this book very, very insightful, very special. It's also extremely well written. In my brief discussion, I wanted to go through some of the things that we're working on at the IMF and some of the things that I've been thinking about personally, and use that as a platform to ask a few questions to you, Chris. The first one is about the timing of regulation. Do you start to regulate early or late while there is a significant innovation in the market? You speak about this in the book, and many of our member countries actually ask us this question. In the book, you say that the US tends to regulate late and the Euro area tends to regulate early. And you take sides with the US. You believe that that allows for more innovation and more clarity also among regulators. And I wonder if that view has changed a little bit given the FTX debacle, which of course does happen. Fraud, criminal activity happens. It's more a function of the people involved rather than the technology, as you explained. Nevertheless, FTX has cast a very long shadow on the industry and may put the industry back by several months, if not a year. And I wonder if earlier regulation might have somehow avoided that. So has your thinking changed?
Thank you for that, Tommaso.
Yes.
Yeah, you know, thank you for that. In my book, I kind of weigh the two different approaches, and I admit that there's a lot of drawbacks to economies that are late to regulate a given innovation, and I express some admiration for, I think, what's a European tendency to want to be early with regulation, not late. I do think it perhaps enables catching some misbehavior before it gets out of hand or closing some gaps early. The downside, however, is that if you get the regulation out too early, I believe, it's my own view, but if you get the regulation out too early, then what innovators start doing now is innovating to address the regulatory concerns, as opposed to innovating to solve commercial and marketplace needs. And I believe the advantage, and there's a lot of disadvantages in coming late with regulating. One of the disadvantages, you may allow others to set global standards. But I think the advantage, and I think one of the reasons why the United States has traditionally been a very innovative economy, is by regulating late, you allow entrepreneurs to address commercial needs, market needs, as opposed to regulatory needs. And ultimately, what drives economic growth is greater efficiencies in markets. And if entrepreneurs are making markets more efficient, then it's doing us a service. Now, at the same time, regulators can't fall too far behind. They've got to catch up. We need to bring, a lot of our regulation is based upon sound human concepts. What underlies all of our securities regulations, the millions of pages, are a few sound concepts. Transparency. Tell us what you're doing before you take our money. And if you tell us what you're doing, do that and don't do other things. Be truthful. And then a way to verify that, audits, et cetera, so that we know that what you've told us you are doing, and there's an independent verification. It's more complicated than that, but some of these sound principles. And so often with regulation, it's about filling gaps. It's about bringing these already established principles to a new area. Now, what I would say in the case of FTX, the part that didn't fail was the part that was under CFTC supervision. So their derivatives, Bitcoin and Ethereum derivatives trading was under CFTC supervision. And that's the one part of the FTX empire that is currently for sale because there's value there because it didn't fail. The parts that failed were operating in jurisdictions where there was no regulation, or in the one area in the US law, spot Bitcoin trading that is not subject to either SEC or CFTC jurisdiction because of a gap in our law. And that's a gap that for 5 years I've been advocating for Congress to fill that gap. And Congress needs to move forward and do it. And I'm optimistic it will happen this year. And that's a failure of the type you mentioned where the US is too behind. We need to fill that gap. But where the law is in place, it has worked. And I think generally the US coming late to the day has furthered innovation, even if it's allowed for perhaps a few more spectacular scandals around the world here in the US that maybe might have taken place elsewhere.
I think it's, since Natalie hasn't spoken yet, if Tommaso finishes and then we go to Natalie, and then we have a few questions around the chat for Chris, and we give everybody a chance to talk, because this is so passionate. I can see it, then we won't be able to hear entirely what Tommaso has to say on Natalie. So Tommaso, you have 5 minutes now to give us more questions.
Very much. I love the passion, and of course, maybe some of the questions will remain unanswered, Chris, and we'll meet in New York to talk more about this, or in DC when you're here. But I wanted to bring up a couple of additional points. One is perhaps a deeper point about FTX, and that is the role of intermediaries. So some people's understanding of crypto assets or the crypto world is that you don't need intermediaries. And of course, the failure of FTX has turned that onto its head and suggests that you still need intermediaries like FTX. And the problem comes from the intermediaries. So the world hasn't really changed. We're back to a world of intermediaries that need to be regulated. And I think this comes from a misunderstanding of what crypto is really about. I think you said it well in your remarks. There is no longer the need for an intermediary in settlement. Settlement can happen on the blockchain. But of course, there may be intermediaries that issue new forms of money, such as stablecoins, and you still need to trust those intermediaries. Those intermediaries still need to be regulated. And I suppose you would agree with that.
So here's what, if I could, it's a very important point. It's very important, actually, anybody who's interested in this area, if you haven't had a chance to read the Satoshi Nakamoto white paper, read it. It's only 9 pages long. It's amazing how, in the common parlance, people ascribe to it things that it doesn't actually say. So I've heard people say that its fundamental premise is to move finance out of government regulation. It doesn't mention government regulation at all. That's not one of its premises. It also doesn't say we'll do away with intermediaries. What it does say is that we'll move money from a bank account-based system to an internet-based system. And maybe on an internet-based system, we don't need the same degree of intermediaries. We don't need as many intermediaries. But, in human history, there have always been intermediaries. I often tell a story. I was in a dentist's office. I picked up a magazine on the table while I was waiting. It was something called Archaeology Today. And there was a story about the blocks used to build the pyramids, and that they were able to find some of the blocks that had inscribed into them markings, and they translated the markings, and the markings were the name of the brokers who brokered the blocks to the pharaohs to build the pyramids. There's been intermediaries in human society since early ages, and I have a feeling there'll be intermediaries in human society to the end of time. And that is because once you have more than, say, a dozen actors in a given area, there becomes a dynamic where you want somebody to be a go-between, simply because you can't go to all 12 at the same time or in sequence without things moving. And brokers have a way of knowing that. So I'm not saying an internet future is a intermediary-less future, but the concept is, just as, quite frankly, the first wave of the internet didn't do away with intermediaries. We have Amazon, we have eBay, we have intermediaries. But the notion is that the architecture would move away from an architecture built on the balance sheets of proprietary commercial institutions to an architecture that's network-based, digital network-based. I think that's the fundamental architectural change.
Absolutely, absolutely, and I quite agree with you. And this leads me to my next point, which is about tokenization. And you have this very nice discussion of moving of the value of tokenization. It's very convenient for us to meet on the town square and exchange a gold coin. I don't need to trust you. You don't need to trust me. As long as you trust the gold coin, you're happy. And by giving you the coin, I've settled the transaction. We can both be off. The only problem is that we have to meet in the town square. And in today's world, that's difficult. Now, you suggest that tokenization solves that problem. With digital tokens, we don't need to meet in the town square. Nevertheless, we can still settle transactions without knowing each other. Now, the problem with these types of bearer instruments is that they're typically anonymous. And there's the whole problem of anonymity. I mean, you speak in your book about some of the pitfalls of controlling information, but there's just as many pitfalls to anonymity. And of course, we know that this favors criminal behavior. It is not consistent with AML, anti-money laundering, and combating the financing of terrorist laws. So how do we get around it? How do we square the circle? I think it's still possible to be KYC'd. It's still possible for an intermediary to know who we are without us knowing each other and us being able to settle in this new way using blockchain technology. So I think we can square the circle with anonymity and still have tokenization.
Yeah, so this is such an important topic, and one that I address in a lengthy paper that I'm publishing in the next week at the American Enterprise Institute, which perhaps maybe we can put on the website once it's launched and readers interested. It's one that we can take a lot of time. But what I would say is, we should look upon digital assets as an opportunity to revisit what we do right now, which is a system where enormous amounts of personal data is transmitted to commercial and government entities without permission. Every day we engage in e-commerce, our data is sucked out by commercial actors. There was an article on the front page of the Wall Street Journal yesterday about how much data of Americans' overseas transactions is taken by government agents without probable cause, without a subpoena, without a warrant, simply because they want the data. So we're not in a good place today in terms of preserving privacy. And I believe that when we go not to a digital asset system that's anonymous, but one that's pseudonymous, where our identity can be preserved unless there's probable cause that we've done something wrong, and then it became uncovered. And what I would point to is the right way of getting at this is what we do in law enforcement every day, on highway law enforcement. In highway law enforcement, we don't do what we do in financial services, that is, get everybody's information before they do a transaction in case they do something wrong. In highway law enforcement, we let people freely onto the highway, and then we use pattern recognition. Somebody's speeding, somebody's reckless driving, somebody's driving without their headlights on. Pattern recognition to identify whether there may be probable cause of something wrong, and then we go and inspect, and finally we get identification. It's an identity last as opposed to an identity first system. Unfortunately, what we do in financial services is we require credential identity even to engage in financial services. That's why we've got 1.5 billion people that are excluded, because this requirement of financial identity first in case you do something wrong. I think with a digital money system, with a digital token system, we can allow transaction activity to take place. And regulators can do the same thing that Facebook and eBay does, that is monitor traffic, apply pattern recognition. And we did some of this at the CFTC, big data analysis, artificial intelligence pattern recognition to see patterns of behavior. If you see that there's 50 transactions this morning between my next door neighbor in New Jersey and some dodgy bank in Nigeria, that may be the probable, and that bank is itself been engaged in criminal activity. That may be the basis to unmask that identity, and turn pseudonymity into identity. But not what we do today, which is just gobble up enormous amounts of data, even for people that are innocent. And so I really think the digital revolution is a chance to rethink the direction we're heading in. And the dirty little secret is the United States and Europe are already heading more to a surveillance system in the analog financial system than we like to admit. And I think digital assets are a chance to be honest with ourselves that we really need to rethink that. It is not, honestly, where we are today does not do justice to the free society, democratic society that we like to think of ourselves. And I think digital assets are an opportunity to rethink that.
I like that, Chris. I need to go to Natalie because we really want her to say something about CBDC. She's written extensively about it, and then we'll talk more if we have a few minutes at the end. Okay, so Natalie, I'm sorry, Tommaso, I'll get back to you if there's time, but at least you had a chance to say a few things. Natalie, go ahead.
Thank you so much for having me. I'm going to share my presentation here. Can you let me know when you can see my slides?
I can see it. We can see them. Put them in full thing. Yeah, yes.
All
Good.
right.
Thanks.
So I wanted to take a few minutes today to outline what I see as the major political economy issues raised by CBDCs. And I can summarize the broader trend here as a consolidation of bank and state. This is a consolidation of all levels of banking with state regulation and oversight. And I will end my presentation by explaining how Bitcoin offers an alternative to this growing system of control. First, I want to start by cutting through some of the narrative around CBDCs. So this is a quote, many here will be familiar with, President of the Minnesota Federal Reserve, Neil Kashkari, who said last year, I keep asking anybody at the Fed or outside the Fed to explain to me what problem this, meaning a CBDC, is solving. And there have been a number of purported benefits presented as, innovative that CBDCs offer that no other technology does. First is real-time settlement. The contention that our financial system is antiquated and slow, but it doesn't hold up to scrutiny because there are other non-CBDC implementations that already exist that offer the same benefit. For example, FedNow, which is being rolled out this year, and the Bitcoin Lightning Network as the non-state alternative. Second is the benefit of financial inclusion. The billion or so people around the world who don't have access to the existing banking system. But the obstacles to these people creating accounts with the banking system are precisely the identity verification requirements around banking, AML, KYC, and generally low income. They can't afford to pay to maintain minimum deposits or pay banking fees. And neither of these problems are problems that CBDCs will solve. In fact, they expand the orbit of identity verification requirements that is already in place. I've also heard, some allude to CBDCs being a mechanism for wealth redistribution or, increasing socioeconomic equality. And that is emphatically not the case. I mean, CBDCs are just another digital form of base money. There is no redistributive project implicit in any CBDC rollout anywhere in the world. What they do well, though, is that they provide a system to accelerate the full surveillance of financial transactions. So ID verification for CBDC usage is a design requirement in every CBDC implementation. This is not something that regulators or private actors building and implementing CBDC architectures will skip on. That in fact is a benefit for the state that CBDCs offer. The ability to individually target monetary policy is another benefit of CBDCs. So they're fully programmable money, meaning that deposits and spend can be controlled at the individual level and even at the token level. This actually represents a full merger of fiscal policy, monetary policy, and policing. And that's the theme of the conversation coming up here. Another big motivator for states in implementing CBDCs is capturing tax revenue from the quote unquote informal economy. So those who are not included in the banking system transact primarily in physical cash. Many of those transactions are not currently taxed. And so by, in effect, replacing physical cash, which is what CBDCs will eventually do, and requiring that ID verification, states do intend to capture that additional tax revenue. And then finally, for the BRICS countries, the incentive to build a CBDC network is that they are able to create a alternative to the US dominated global financial system. And this has become much more urgent after the United States froze Afghanistan's and Russia's sovereign reserves over the past few years. It's made clear to sovereign actors that their FX reserves are not safe if they're not directly custodied, that money has become fully politicized. And so what is happening is that different political monetary systems are being built out in response to the political US dominated global monetary system. As Chairman Giancarlo mentioned, CBDCs are already very advanced in implementation in countries around the world. This process of developing and launching CBDCs is happening entirely outside of the democratic process and without feedback from the populations of any country in which they are being implemented. Where we have pilot projects of CBDCs in the field, for example, in China, Nigeria, the Bahamas, Eastern Caribbean, it's clear that the people don't want to use them. They see them as surveillance coins. They see them as attempts to corral people into the use of fiat currencies that many of them don't want to use. And so there is a coercive element to the implementation of CBDCs that is not being taken into account at all in these debates at the state level. And so I want to take a step back and, CBDCs are just one symptom of a broader problem that I see as the growth of the surveillance state. This is a kind of momentum wherein the state grows the amount of data that it collects on ordinary people, with basically very little in the form of a countervailing push from civil society. And so we've seen, for example, that, you know, the United States intelligence agency network has grown dramatically. It now costs, you know, the taxpayer almost $90 billion a year. There are continuously new intelligence agencies added. This is just at the federal level. Most Americans have never heard of most of these agencies. And in fact, it's unclear really how many total federal agencies there are. There is no one authoritative source that spells out all of the US federal agencies and their mandates. There are various sources depending on how agency is defined, and there is no standard definition of agency. Place the numbers at, you know, anywhere from around 60 to over 400. And so how can we, in fact, understand or rein in abuses of the administrative state if we can't even document that state in its current state? Surveillance systems are poised only to grow. Cities across the world, and the United States is no exception, are implementing more stringent surveillance practices. There's a lot of funding to do this. Some of the infrastructure bill funding is doing this, but then also, you know, municipal and state appropriations are doing this. This points to the broader trend that's been identified by some historians as surveillance capitalism. Surveillance capitalism is an accelerating surveillance economy in which both private actors and state actors stand to benefit from growing surveillance of the general population. In the case of the state, surveillance affords control, the ability to influence behavior at scale. In the case of the private sector, that type of behavioral influence affords profit. And so, in the words of criminal law scholar Andrew Guthrie Ferguson, what is different about the system of surveillance today from the type of surveillance that, say, is afforded law enforcement in the Constitution is its scope and persistence. It is automated, it is accelerating, it is accurate, it accumulates data, it aggregates that data, and then actualizes that data. And of course, it is persistent, pervasive, and profitable. So this brings us to a discussion of AML KYC, which was brought up in the conversation earlier. And my contention here is that AML KYC is basically a global system of warrantless surveillance that has in effect made constitutional protections like the subpoena process irrelevant. And here I actually quote Chairman Giancarlo from your book. You correctly point out that Fourth Amendment privacy protections have been eroded considerably since the attacks of September 11th, 2001. In fact, no account-based transactions are truly private because in every case, they require personal identity as a prerequisite step. And this, of course, will be a core component of CBDC infrastructures. This is a quote from the US Federal Reserve's report or white paper on CBDCs that was published in January of last year. So exactly 1 year ago, any CBDC intermediary would need to verify the identity of a person accessing CBDC, just as banks and other financial institutions currently verify the identities of their customers. So, you know, this brought to my mind a quote from Timothy May, one of the cypherpunks, who wrote in the 1990s that the four horsemen of the infocalypse will be used to justify doing away with privacy online. These are terrorists, pedophiles, drug dealers, and money launderers. And we're seeing that in action today. This is just a short list of US-based AML laws. starting with the 1970 Bank Secrecy Act. There's basically a new AML law every few years. The 2001 Patriot Act was perhaps the most significant of these in recent memory. And we've also seen since 1989 the establishment of the Financial Action Task Force, which is a global network of financial police, FinCEN, and the U.S. Treasury Office of Intelligence and Analysis. The overall trends here are that reporting thresholds for financial transactions are being continually lowered. These government and para-government organizations are not subject to the data protection laws that commercial actors are. And so they maintain, profiles on billions of people without any of the imperative to delete that data, to, make citizens aware that that data is being collected, to modify that data if it's inaccurate. And then, of course, they all share information between one another. One of the results commercially of AML laws is that anywhere between 30% and 65% of declined transactions globally are in fact legitimate. And so that results in up to $640 billion in lost revenue, not to mention the hassle that ordinary people have to go through to unblock cards and bank accounts that have been frozen due to some fraud algorithm being tripped. A question that is rarely asked is, how effective is anti-money laundering legislation? In 2018, Ronald Pohl did a comprehensive study of the effectiveness of AML laws worldwide and came to the conclusion that less than 0.1% is the impact that AML laws actually have on criminal finances. Compliance costs, however, exceed those recovered criminal funds more than 100 times over, and banks, taxpayers, and ordinary citizens are penalized more than criminal enterprises. And so, as with all surveillance, it's surveillance for those who lack the power to circumvent the surveillance. This is a quote from the former director of Europol, Rob Wainbright, also from 2018. Professional money launderers, and we've identified 400 at the top level in Europe, are running billions of illegal drug and other criminal profits through the banking system with a 99% success rate. So again, we must ask, who are these laws for? This is a short history of US government insistence on exceptional access, which is basically the requirement that encryption backdoors be put in services and products used by ordinary people. Obviously the Snowden revelations put a lot of this into mainstream conversation, but it's important to note that none of the programs identified by Edward Snowden have actually been formally sunset as a result of the public outcry. All of this, whether it's secret NSA key provisioning services and recovery services, warrantless surveillance under Section 702 of FISA, PRISM, Upstream, all of these are ongoing programs and not checked by really any democratic body. Most recently, the Treasury Department's Office of Intelligence Analysis was revealed to be basically illegally rifling through the private financial records of millions of US citizens, which it was collecting illegally from FinCEN. The NSA was also accessing that data illegally. There was a brief outcry about this, but this got caught in the bureaucratic turf war between the Treasury, OIA, and FinCEN, both of which are Treasury departments. There was a politicized aspect to this battle, and so it just kind of quietly went away. Just a couple of days ago, the Wall Street Journal broke a story that the Arizona Attorney General's office created a program called TRACK, to basically just collect data on money transfers from Western Union with the full collaboration of Western Union. 150 million money transfers are stored in this database. Also completely illegal, didn't go through the subpoena process. But again, we'll see if there are any consequences for this. And so what this points to is really the incompatibility of a surveillance state with democratic governance. And this incompatibility was recognized by none other than former director of the FBI, James Comey, who was very upset by the fact that end-to-end encrypted messaging apps existed that the FBI could not access. And he explicitly said in 2015 that that's a problem with democracy. And so what we're seeing is a kind of a consolidation by the state away from democratic governance, the continued expectation of democratic governance on the part of the people, and these incommensurate point of views are not in dialogue with one another. So in the context of banking and CBDCs, this consolidation of state authority is represented most clearly by the blurring of the distinction between central and commercial banks. So central banks have commitments to backstopping customer deposits. And so if central banks are put in competition with commercial banks for deposits, modeling has shown, for example, in a paper by the Philadelphia Fed, that consumers will overwhelmingly prefer the central banks and will gravitate to central banks over time. This is why most CBDC designs have this fig leaf of separation between central and commercial banks, where they are wholesale CBDCs and not retail CBDCs. However, in practice, this really is nothing more than a fig leaf because could we get a mute maybe?
Mute.
Yeah,
Sorry.
thank you. Because ultimately, the retail CBDC accounts that will be managed by commercial banks will still be fully subject to central bank oversight and targeted monetary policy. So, you know, $5,000 is about the median checking account balance in the United States. CBDC account caps at less than this amount would certainly be required to avoid significantly cannibalizing commercial bank deposits. This was already put in place by the Central Bank of the Bahamas in their Sand Dollar initiative. Identity verified CBDC accounts are capped at $5,000 annual balance, and non-identity verified accounts are capped at $500. So that's quite a low amount, and again raises questions about the future of commercial banking under CBDC regimes. And then, finally, we get to this question of, whether central banks are in fact independent at all. The 80s and 90s were kind of the high point of central bank independence globally, but since that time, and particularly since the Great Financial Crisis, central banks' implicit mandate to maintain economic stability has resulted in more direct political control over its functions. So, things like bailouts, targeted monetary policy, so the different distributional impacts of monetary policy, the pressure on central banks to be more transparent about their goals and objectives, all of that introduces, these are all political dimensions of central banking. And in fact, maintaining the stability of the financial system as a whole is often at odds with the imperative to maintain price stability or control inflation, which is another mandate of central banks. And so how that trade-off is made is a political decision. So I want to end with this metaphor of, the airport as a paradigm for the emerging bank state. The airport is a quintessential border institution. As the world has internationalized and state capacity has grown, This difference between inside and outside, local and foreign, has collapsed into a permanent state of familiar otherness, a vigilant containment that is not hospitality and never becomes solidarity. The airport is a space of both law and lawlessness, in which the distinction between those two is often erased. And so here I want to bring in philosopher Giorgio Agamben, who has theorized extensively the lawless law that characterizes the state of exception. The state of exception is, you can think of it as akin to the Roman justitium, which was generally proclaimed during the state of tumultus, when the Roman state was threatened from either without or within. The justitium was the suspension of law that enabled the Roman state to raise an army and confront whatever the threat was. This was, a zone of anomie, in the words of Agamben, in which all legal determinations are deactivated. And it also functions as a threshold of indeterminacy between democracy and absolutism, and a threshold of indifference between anomie and law. In other words, if the law encompasses everything or nothing, then the distinction between law and lawlessness is meaningless. And so, why Bitcoin? It is virtually impossible to reverse the momentum of state consolidation of power as such. So the state will not constrain itself. The only long-term checks on state power emerge from a civil society whose power is significant enough that the state fears it. This is the thesis of Daron Acemoglu and James Robinson, two historians, one at MIT, one at the University of Chicago. In their book, The Narrow Corridor, they suggest that the only thing that preserves liberty in the long run is something called the Red Queen effect. And that is an analogy taken from Alice in Wonderland, where Alice races the Red Queen. And the Red Queen represents the state, Alice represents society, and this constant race, the maintaining of parity in the capacities between state and society, is what ensures liberty. So the universalization of end-to-end encryption and a direct ownership model of censorship-resistant digital assets, in this case, in the case of the bank state, that is what reasserts civil society's power in the face of that growing state consolidation of power. And so I would suggest here that Bitcoin's most important property is precisely its statelessness and its censorship resistance. It mirrors physical cash in that it is a bearer asset that can be exchanged directly without identity verification. It is a guarantor of individual liberties at the protocol level. There is no one party or set of parties that controls the protocol. It's a complex set of game theoretic conditions that ensure that incentives remain appropriately distributed and balanced. Bitcoin, for this reason, enables direct peer-to-peer transacting using quote-unquote self-hosted wallets, basically a digital version of the wallet you carry around in your pocket. And it serves as a monetary DMZ, or demilitarized zone, for states. So it represents a non-political alternative to the US-controlled and the BRICS-controlled financial systems. And central to this liberatory potential of Bitcoin is the fact that it represents a move away from the account model of digital asset custody. So anytime we're talking about a third-party trusted custodian, we're talking about centralized implementation of public key infrastructure in which some custodian holds the private keys that determine ownership of an asset. Bitcoin is an implementation of decentralized PKI, meaning it represents a direct model of digital asset custody. The asset is custodied by the end user who owns their private keys and therefore can operate in a self-sovereign manner. And so this is critical. Bitcoin has no customers. That is why there cannot be AML KYC requirements for the use of Bitcoin. It is a tool. Tools create inclusion as people freely adopt them, not based on top-down coercion. And so ultimately the takeaway here is that liberty is a bottom-up process. And as states move forward with implementing CBDCs, having a liberty-oriented alternative like Bitcoin will be key to ensuring that a space for freedom continues to exist. Thank you.
Natalie, that was fantastic. I just want to give the mic back to Tommaso for a couple of minutes because he has to leave, and then we circle back to Chris if there are any other questions. Tommaso, you still there?
I'm here. Yes, Nicoletta.
Yeah, sorry, I cut you off, but I think it was important to at least go ahead.
I thought we were going until 1:15, so I actually have another meeting.
We were, but then we brought to the fore some of the discussion so that yeah, it's lived a little bit. But if you have something to add, I think you had a perspective on the fund. If you have a couple more minutes.
I had actually prepared a whole discussion of some of the Giancarlo's Chris's book, but I guess one last question to leave with Chris, and of course one of the areas on which we're working is who will provide the money that we will use in this new digitalized world. There are various options. There is of course the unbacked crypto asset, which we would argue is not money, does not have a stable store of value. There is the possibility of very well-regulated stablecoins, and I agree with you, I don't like the word stablecoin either. It's a catch-all, but we might imagine that with sufficiently clear regulation, we have some sort of coin that is denominated in a monetary unit of account and it can be redeemed at par in any state of the world upon demand. I'm not sure what the business model will be to issue that type of coin, but it is a possibility. And then, of course, there is the possibility that commercial banks get involved and digitalize their deposits, which could then be transferred in on a blockchain or on some sort of ledger. And there are all sorts of questions about how that might be developed, whether the digital version of commercial bank deposits could be transferred to people who are not customers of the issuing commercial bank, or whether you need some sort of other arrangement for interoperability, and whether that arrangement might be CBDC, so a digital version of central bank reserves that acts both as an monetary instrument to settle transactions across different issuers and as infrastructure to ensure interoperability, just as today central bank payment infrastructures allows for interoperability. And then, of course, the next step, which is also one that we're interested in, is the digitalization of financial assets, say bonds, equities, commodities, and whether those will take off, what value there is in that, what friction do they solve, and if they were to take off, then of course you would need money on the blockchain to pay for them. And so perhaps until now we've become enamored with the idea of paying for coffee with digital money because we're all consumers, we all pay for coffee in the morning. But that is more the tail wagging of the dog, whereas in fact, if digital assets really were to take off, they would require digital money for settlement. That would be the dog wagging of the tail again, just given the volumes and the use cases. We could, of course, go beyond and think about the role of CBDC in that world, the role of CBDC as both monetary instrument and infrastructure to allow for interoperability, not just between different issuers of money, but also between issuers of money and issuers of digital assets. And that, of course, is a world that I'd love to debate with you. Unfortunately, I know we're out of time, but I just wanted to put those ideas on the table. And I do hope to meet you soon and to continue the discussion. It's been fascinating. Thank you very much. And I hope to see you soon.
Thank you, Tommaso. That was excellent questions and food for thought of the role. And so I think I can pass it back to Chris for a moment. I mean, my own take from the whole discussion is that, you know, there's this revolution. It's is going to happen willy-nilly, and a lot of that has already happened. I mean, you have been a regulator of these markets, so these things are old to some extent, and even if people haven't heard about them. But in one thing is the future of digital money, which you have, and I think Natalie also explained. There's a lot of merit, and I think that some of that, and the other is the issue of public digital money, and especially monopolistic digital money. With all this privacy risks. So I don't know. I know in your book you sort of start with a word where it's really the peer-to-peer concept, where this freedom is unleashed. The internet of value, but then it seems a different philosophy from the CBDC. So if you want to say a few words about that, and what Tommaso, his last thoughts about the role of the intermediary, that'd be really, I think, useful.
Thank you, Nicoletta. And I want to respond to some of those thoughts of yours and Tommaso's, but with reference to Natalie's, I think, excellent presentation, much of which I very much agree with. The concern about privacy ultimately, to me, is the fight for the future of money. The move to a digital architecture of value, I think, can either be the sunsetting of our fundamental freedoms as a free people, or hopefully a new beginning. And why do I say that? When you think about our constitutional rights, freedom of speech, freedom of assembly, freedom of religion, freedom of privacy in our own person in the Fourth Amendment, in a free market economy, what are those freedoms other than how we spend our money, right? We speech in the media we consume, in the utterances we make on Twitter and on Facebook. We assemble by organizations that we pay dues to, right? We exercise our freedom of religion or not religion by organizations we belong to. And so if the degree we already have of surveillance and censorship is expanded in a new digital era, then we've effectively lost those freedoms. There will be freedoms in name only. But I actually think, and I think Natalie touched upon this itself, there is this technology, and she points to Bitcoin, and certainly I think Bitcoin has censorship resistance built into it, has privacy protection built into it. It gives us a vision of how to use this digital technology as a way to stop the trend we're on and reverse it. Now, I want to point out something. There's many out there who say CBDC bad, private operated digital money good. Well, what we're seeing in the Twitter files proves that just because you outsource the public square to a private actor, your privacy may be more infringed, right? Government will lean on private actors, and you can see a bad future where government says, okay, we won't do CBDC, we'll allow private actors to operate stablecoins, and then we'll tell them what to censor and what to surveil. We'll tell them you can't use that stablecoin to fund Planned Parenthood if it's a right-wing government, or you can't use it to fund Right to Life if you're a left-wing government, or you can't buy ammunition, so on and so forth. And those private actors aren't governed by the First Amendment. So one of the arguments for CBDC, if we get it privacy right, is at least the government is subject to constitutional protections, the private sector is not. Now, I will tell you that I'm very much supportive of a world that we might go to where Bitcoin could be money for all the reasons Natalie says. But I would tell you, having spent 5 years in Washington and a lifetime in a pre and post 9/11 world, I'm not sure governments are moving away from CBDC or will give that up. Okay, my guess is within 15 years, a third of the globe, as I said before, will be using China's digital currency. My guess is the Eurozone will be using a digital euro currency. And my guess is the United States will deploy a CBDC, whether we like it or not, whatever arguments we have. And so we at the Digital Dollar Project have thought, look, you can have an outside game or an inside game. Our goal is to get in front of it and to make sure that privacy is central to the public's discussion of a CBDC, so that when policymakers take up authorizing it, privacy is front and center. I'll get one more point, and then I'm sure Natalie's got some thoughts, and I don't want to monopolize the conversation. You've already given me a lot of time, and I'm grateful for it. But I'll say one other thing. Last week, I spent a few days on Capitol Hill with some of the senior policymakers and the new House leadership, but on the other side of the aisle as well. And they were all talking about stablecoin legislation. And I asked them, what privacy provisions are you putting in the new stablecoin legislation? And uniformly, the answer was, we haven't thought about that. I said, are you kidding me? You're going to allow operators to operate stablecoins, but you're going to allow them to take all that data? You're going to allow them to be told by government what the stablecoin can be used for? You haven't thought about privacy? We, the people, have not made privacy front and center in this new digital form of money. And that's what we're trying to do with the Digital Dollar Project. And I think that's got to be part of every conversation. A good future would, and probably a likely one, would be one where there are CBDCs, because I think that's going to happen, no matter how much we may not want it to happen. But also where Bitcoin is not suppressed, where Bitcoin exists, where stablecoin operators are required to ensure privacy and lack of censorship, and where a CBDC is subject to the First Amendment. And the only way we get to that world is by making privacy front and center in every one of these conversations. Thank you.
Thank you, Chris. I think we're on the same page then there. I would like to give it back to Natalie for a moment. I mean, we've never gone overboard with time, but I think this is so, we still have 100 people on that, but I'm sure people have to go. So we're gonna spend another few minutes and then close off, because this is marvelous. I could stay here all day, but you know, we have a promise in closing on time. So Natalie, do you have a few words to say?
Yeah, I do. I don't think there is any private implementation of a CBDC. I don't think it's possible. I think it's already been precluded. The weaponization of the global banking system and the financial system as a instrument of not just identity verification, but consistent surveillance, that is already a fait accompli. That is done. And a CBDC will not depart from the assumptions underlying the existing financial system, which is also one of the reasons that it's superfluous as an initiative. Like, the global banking system is already fully digital, it's fully surveilled. The main benefits of a CBDC at this point for the state are getting down to that granular programmability of token by token, individual by individual transacting. And so I would suggest CBDCs are a fully lost cause. They likely will be implemented in many countries against the will of the people, often as a surprise. Like, people will hear about them for the first time when a CBDC account is created for them at their bank, and then used to, say, implement a negative 2% interest rate to, recover some of the sovereign debt burden of that bank. And so people will begin flocking to Bitcoin, not because they love Bitcoin, but simply because it will be the only non-state self-sovereign alternative out there.
Well, we'll have to live this through and see it. And Chris is working on these topics. I think Natalie is working on this topic. And of course, the IMF is working on this topic. I hope you can, first of all, I need to thank immensely Chris for joining us and sharing the insights of his book and his experience and the very deep knowledge about these topics, and for putting himself into this this fight, right? Gloves off. And Natalie for a very important, I think, perspective of the risks and of the need of awakening of the society and the demand we need to ask to regulators and state operators. And Tommaso for, of course, his intelligent, insightful questions. Please share the recording with anybody you know, because the debate has to continue. If I can, I'll try to copy the chat and send this to some of the speakers in case I have time to get back to some of these questions. But also, there's going to be raffled 100 copies of the book So you'll be contacted by the Library of the IMF with a free book if you were among the first 100 participants. And thanks to all a lot. And we're here. I think we have our eyes open, and we're gonna all contribute to the debate if we engage in the debate. And I think today maybe it was a primer for many, maybe it wasn't. But good luck to Chris and to Natalie for the work, and Tommaso, who's gone. Thank you so much. Goodbye. Have a great day. Thank you so much. Bye.
Thank you.